Hello friends, you're welcome to my new video. Happy New Year friends. This is my first video of the year 2022. Like we have seen, we are going to be talking about order flow. When we talk about order flow, we have the external order flow, which is the order flow for the higher time frame structure, and we also have the internal order flow, which is pertaining to the lower time frame structure. All we are going to be doing is to identify order flow once we have a break of structure, and then we look for either a fresh supply zone or a fresh demand zone. That is a zone that has never been tested that led to the break of the structure. On the schematic that is mapped out, we are looking at a bullish structure on the higher time frame. Here we have the low, the high, a bearish break, and then a bullish break to form a higher high. Then we have another bullish break to form a higher high. When we have this bullish break, we look at the lowest point price got to before the break, and that's going to be our lower high, our higher low. Then we have another break. We look for the lowest point price got to is going to be our higher low. So you can see that the higher time frame structure is bullish, making higher highs, higher highs, higher highs, and the lows are being protected, making higher lows and higher lows. But meanwhile, on the retracement, for instance, of the higher time frame, we have a bearish trend, or what we refer to as a bearish order flow. So quickly, let's try to identify the order flow. Like we said, once we have a break of structure, we look for either a fresh supply or demand zone that led to the break of structure. But in this case, we have a bullish break, so we are going to look for the demand zone, the fresh demand zone that led to the break of structure. We are going to be considering the extreme zone that led to the break of structure for us to take safer trades. Now we have another break of structure here. We look for the extreme and a fresh demand zone that led to the break of the structure. When we have another break of structure, we look for the extreme and the fresh demand zone that led to the break of structure. When we have our zones, what we do is simply to wait for price to come to our zone and hope that the market reacts from our zone or reverse from our zone. So another concept we shall be looking at is we are going to be looking at the price action as price returns to the zone. You can see that in most cases, if price leaves the zone, it is usually very fast, with bigger candles. But when price is coming to the zone, we have smaller candle, a condition where we have compression. So compression could well be a way of giving more credence to our zone, what we call an added confluence, that possibly our zone we may see price either reversing from our zone or reacting from our zone. So that is taken. Alright, by the time we mark these zones on the higher time frame, we have what we call the external order flow, which is bullish in this case. Okay, bullish in this is the external order flow. Simply the order flow for the higher time frame structure. And like we said, the retracement here is going to give us a bearish order flow on the lower time frame. We have a bearish break. We look for, in this case, the supply zone that led to the bearish break, and we can wait for price to come back to the zone for us to take a possible sell trade. Okay, we have a bearish break again. We look for that zone, and you can see that in this case price never got to our zone. It happens several times, and once again we have a bearish break. We mark our supply zone, and by this time we see that price has already started reacting from the higher time frame demand zone. In this case, please, it's very risky for you to consider this zone holding, because price is now reacting from the higher time frame demand zone in order for price to create a new impulsive move. In this case, we should rather be buying instead of selling, and our target should be here. Our safest target should be the previous higher high. Okay, so you can see that these internal order flows that we're holding initially has now become liquidity, as price is impulsing upwards. And take note very, very seriously as well. If price breaks this high, be very careful. Okay, before then, we can actually start buying from here. Okay, we can actually start buying. When we have a break of structure, we mark our demand zone, wait for price to get back to our demand zone. This is the internal structure. We can trade the internal structure and take our trade safely. Price breaks this high, we look for our demand zone. Price never came to our demand zone. Price breaks this high. Finally, price did not only break the lower time frame or the internal structure, but ended up breaking the external structure. When you have this, or the higher time frame structure, when you have this situation, you have to be very careful, because most likely price will be retracing, and when price is retracing, all of these zones, demand zones that we are holding price, will best most of the time become liquidity until price gets to the demand zone of the higher time frame, and price takes off again. So that's the point I really want to explain. When you are trading on the lower time frame, you need to know what price is doing on the higher time frame so that you'll be safe. At a particular point in time, this was our range. From here to here is our range. Then we have a break of this high. We now have a new range. Then we have a break of this high. Currently, this is our range that we're trading from. So we expect price to do what? To trade within this range and eventually break this high if the uptrend is to continue. Another thing we're going to be discussing that majority of us already know is the zones where price reacts from. There are two main zones. We have the supply zone and the demand zone. So we are starting with the supply zone. And for the supply zones, we have the DBD, which is the drop-based drop formation, and the rally-based drop formation. But for the sake of this video, we are going to be considering only the drop-based drop formation. So what do we mean by the drop-based drop? As a supply zone, we have a candle that is here, and we have another candle that is dropping. This is clearer. We have a candle, a bearish candle, and within the bearish candle, the two bearish candles, we have what? A candle that looks like this, most times like a spinny top or an indecision candle. This serves as a base. This is clear because it is visible. The main focus of this section is just to show us that we have what we call hidden base. okay, we have what we call hidden base. The base in this case is not visible. And why is this so? It is so because this may just be a representation on a higher time frame, while this will be a representation on the lower time frame. So what we are trying to say is that they have equal power. They are both the same thing. They are both supply zones, and price could best react from them. Like the example we're going to be showing you now. Let me just zoom out so you can see what we're trying to say. You see, after price takes out this liquidity, we have a break of structure sponsored by this by this supply zone. And you can see what happened. Is a liquidity inducement. Price finally came, liquidity inducement as well, tap into that zone and takes off. So you can see the power of this kind of hidden base. This is a drop-based drop formation. Okay, now if you look at this carefully, this is the visible base type of drop-based drop formation. There's liquidity grab here, okay, and price break structure, creating a drop-based drop formation. And you can see how price came, tapped it, and give you a nice trade if you would have taken that trade while waiting for this one. Okay, so that's just an example we're trying to show us. The main focus, like I said, is to tell us that when we see things like this, it's also very important. And how do you mark it? The low of the previous candle to the high of the preceding candle. We form the base most of the time. Okay. Then we are looking at the demand zone example. For the demand zone, we have the rally-based rally and drop-based rally. But again, we are going to be focusing on the rally-based rally formations. Now, our main focus is to sensitize us that there's what we call hidden base, which, like I said, could be a representation on a higher time frame, and this, which is a visible base, can be a representation on the lower time frame. This is the rally, this is the base, and this is the rally. The rally, the base, and the rally. Okay? So we have examples here. Like in this case, let's zoom this out. So you can see this is a good example of a hidden base, led to break of structure, price came back to it and takes off. Okay, now we have an example of a visible base here, rally. We have this base here, rally, and see what happened. Price came back to it, takes off, came back again, takes off, clears liquidity again, and still takes off. Okay, so that's what we're trying to say. Now quickly, we are going to be looking at read chart illustration, higher time frame structure, and the lower time frame structure. Firstly, I started with a schematic. This is just the read chart illustration of that particular schematic that I started with. So we have the higher time frame structure. We have the low, high, low, bullish break to form higher high, higher low, higher high. You see price almost coming down. Okay, so this is just showing us how to map out our structure. So in this case, if you look at this chart, it's kind of bullish. It's kind of bullish because it's creating higher highs, and higher lows. Okay, so we don't expect price to break this higher lows. To some persons, this is what they refer to as the strong high, the strong low, because we don't expect price to break it. And we have the weak highs. I really like the concept of strong low, weak high, strong high, weak low. Okay, it really gives you a sensitive way of trading. Okay, so that's done. The next thing we're going to be doing is to realize that in this higher time frame structure, we also have internal structure telling us about the fact that the price is what? Fractal. And we're going to try as much as possible to, show us those internal structure. For example, here we have the high and we have the low. For the internal structure, we have the lower high, lower low, lower high, and lower low. This is actually a downtrend, okay? So we can mark them out. Then we have this high, we have this low, and eventually what happens, we have a break of structure here. We have a break of structure here, which is a bullish break of structure. When we have this break of structure here, it's telling us that price may be changing direction from the lower time, from the bearish trend to a bullish trend. So in that case, we have a higher high, a higher low, a higher high. And what happened? We now had what? A lower low. In that case, we had a lower low because we have this break of structure here to give us that lower low. Okay, so we continue with the mapping. Have this lower low, we have this lower high, lower low, lower high, lower low, which is also the low of the higher time frame structure, and we have what? A higher high, a high higher than that. That tells us that we have a break of structure here as well, a bullish break to form the higher high. Continue with our mapping. After the higher high, we form what? A higher low. After this break, that was the lowest point before the break. This is the lowest point. Form a higher high, higher low. Okay, before the break. Higher high, higher low. We have a break as well. We have this break, so this is going to be our higher low, then higher high. Then finally, we have this break here. So that tells us that price is ready to come down. And we're not trading because we have this break of structure. We're not trading within this range, this range. So we expect price to come and go up that way. Okay. So that's how we map the lower time frame structure within the higher time frame structure. And again, we need to do something. We will not want to trade only the higher time frame structure. We can actually trade the lower time frame structure, that is the internal order flow. And so we are going to be focusing on this area for us to see an opportunity to trade. That's what we have in the next slide. So we have a 1 hour supply zone that led to break of structure. You see the way price actually, moved back towards it. But to be frank, price did not get to my zone very, very close. Okay. But then we are moving on to this other aspect. We have two opportunities there. More opportunities, but I'm showing us two opportunities which there we can actually trade from. In this case, we have a 15 minutes order block, which is generally a supply zone. We have this break of structure here, and we expect price to do what? To come back to the zone to mitigate the other block. So you can see these candles, these bearish candles. You can see how price, spend little time getting to this level, and you see the time that price actually spent going back. So by the time you see this move, this is what we call compression. When you see compression like this, then you begin to be more confident that price may most likely react from the zone. So some of us can decide to take our limit from this 15 minutes order block and target this low. But what I would like doing is to scale down and look for a confirmation entry on a much lower time frame. For instance, we scale down to the 5 minutes time frame, and this is exactly what we have. On the 5 minutes time frame, what we want to see as price approaches the zone, we want to see a stop hunt, a liquidity grab, then we want to see a break of structure, or what we call change of character, chalk, to confirm that price is now reversing. It's now changing trend from uptrend to downtrend. And we look for a fresh demand supply zone, in this case, a fresh supply zone for price to mitigate, and we look to take our trade for a much higher risk to reward ratio. I wanted to say a much lower stop loss range. That's exactly what we'll be doing. So that's what we have here. You can see once again, like I said, we have compression here, which we are going to see later. And we are going to be focusing on this area. You can see what I explained. Price came into the zone, grab liquidity, and we have a very good change of character, which is good break of this structure, this low, this sensitive low that grab liquidity. We have this break, a very nice break, and this is what we call expansion. Okay, when we see this expansion here, you will notice that we have this institutional candle, or this buy before sell candle. Then we also notice that we have a bearish engulfing candle, which is very powerful in determining the strength of a zone. Shows that there's much power in selling this market. And so we mark that zone, and price nicely went back to that zone, mitigated the 5 minutes of the block. We're on the 5 minutes time frame now. You can see that if you have traded based on this confirmation entry, you would have made about 6.27 arrow trade. Sorry, this is an error. Why, if you traded based on 15 minutes order block, you might end up making about 2.88 arrow. So you can see the difference and why confirmation entry is always good. But most times you see that you might not always get this opportunity. Price may just be so aggressive and you may just miss out on the trade. But then, like I always say, stick to your strategy. You cannot win all the time. Okay? So this is the compression I was telling you, from this region to this zone, this area. You can see the price was actually experiencing compression. Okay? Now we're going to be looking at other opportunities. Quickly, I also want to show us this hidden base example. We are on the 6-hour chart. You can see what the hidden base did. Price tapped into it and takes off. Once again, because of that, we are expecting that price is also going to do the same here. We have a hidden base, and since price has already breaking the main structure, we can't expect all of this internal order flow to become liquidity. So price can come to this zone and takes off from that zone. Okay, come here, it takes off. There's a possibility, of price doing that. Okay, so we are going to be focusing again on this. Okay, like we said, this is the range high, range low. Yes, we've already said that before. And we're going to focus in more on this area, this internal structure or internal order flow, for more opportunities to trade. In fact, we have two opportunities here. So we're going to see that in our next slide. This is the first opportunity. We have liquidity grab here. Okay. And then we have what? A break of structure. Finally, price breaking the structure aggressively, and see that smart money is involved, creating what? Imbalances, and this liquidity inducements, approximately double equal lows. Liquidity inducement, price came, tapped into it, and once again you can see what we mean by the hidden base. You can see how price reacted very, very beautifully from this, reversed beautifully from this hidden base example. And once again, you can see how price came back to the zone compression. By the time you see this, like I said, you will have more confidence that price will be reacting or reversing from that zone. Okay, so you can see how price gave us a very good 15 arrow trade here. The next opportunity is going to be based on this. Let me show you carefully this demand zone here, which is the rally base rally. In this case, it is very, very visible. So that's what we'll be looking at in the next opportunity. So this is what we have, and price gave us a very nice trade for possibly 7 arrows. And one thing we'll notice that after this, remember we're trading the internal structure or internal order flow. These are internal order flow. You can notice that after the break of the higher time frame structure, this, for instance, this demand zone that was holding, this internal order flow demand zone that was holding, is now acting as liquidity. You can see exactly how price came, break it. That is why they are telling you that if a zone has been tested before and other block has been tested, please do not rely on that zone. That is exactly what they are telling you. Because now price is retracing, and all of this is going to be, the internal structure is going to be liquidity in this case, until price gets to either a discounted area or a fresh zone on the higher time frame to take it up higher. Okay, so this is exactly what we're saying. All of this now becoming what? Liquidity. Price grabbing liquidity, and price may be heading down to take this trend line liquidity, and we'll be heading here. Okay, battery is down, so I have to be fast. Then we have the next slide just to explain higher time frame, more example on the British pound US dollar. You can see what the internal order flow is doing. You can see how price is reacting. Here it never touched, and here it breaks structure, break the high, and came down. You can see this, the M30 in this case is the higher time frame. You can see that after the break of the M30 structure, all of these started acting as liquidity. Price came and then break structure to the upside. And after the break of the structure, we may expect price, this is a fresh zone, to come and react from here. Okay, and takes off, because that happened to be the only fresh zone that we can see, and is well in the discounted zone. Okay. So with that, I believe and I hope that you gain one or two value from this video talking about uh, order flow, how you see order flow in terms of the external and internal order flow, and takes advantage of so many trading opportunity. With that, I say goodbye and I wish you the best in your trading. Thank you.